Hello and welcome to my presentation on the financial and competitive situation of Louis Vuitton Moet Hennessy. Starting right in, discussing the business model and the key business segments. As you see right here in this graph, Louis Vuitton Moet Hennessy is separated in 5 big and 1 small business segment, starting with wines and spirits, fashion and leather goods, perfumes and cosmetics, watches and jewelry, as well as selective retailing, and the smallest one, other stuff. The biggest one is fashion and leather goods with high revenue and strong recurring operating profit. This depends on the high fashion brands which are located in the segment, which is Louis Vuitton, Kenzo, Marc Jacobs, as well as Christian Dior, Loewe, Givenchy, and so on. Then looking at the asset structure, having non-current assets around 76% and current assets around 24% in the company. Statuing this amount of percentage, like brand names and other intangible assets, around 17%, and the biggest chop of non-current assets are total intangible assets. Looking at the current assets with a strong cash and equivalent chop. Looking at the debt structure and financing situation, having equity around 38% of whole assets, which is a really strong equity base, supports creditworthiness and absorbs volatility. Then going on to the long-term borrowings, which are the main gross financial debt item, but only around 7%. So now going on with the benchmarking against Kering SA, which is also a holding of different high luxury brands, as for example Gucci. And as we see right here, Louis Vuitton Moet Hennessy is the stronger company, topping most aspects, indeed, of gross margin and cash flow margin, as well as the adjusted free cash flow margin. But the gross margin does not really translate into the stronger operating profitability. The free cash flow margin is also higher in Kering because of the strategic real estate disposals in 2025. Now we have the more in-depth benchmarking. As we see here, Kering has the much lower revenue per year. The recurring operating income of Louis Vuitton Moet Hennessy is also way higher. The net profit is way higher. Operating cash flow is way higher. And free cash flow, as we see here, is also around 3 times, 4 times of Kering. But when you come down here, Kering is operating a little bit more efficient on the gross margin, but also on the net profit margin. Louis Vuitton Moet Hennessy is just a stronger, better company. The operating cash flow margin of the both companies is close, but also Louis Vuitton Moet Hennessy is better. So, and then Kering shows up with the reported free cash flow margin, which I already explained is due to the strategic disposals. Down here, which is also a really interesting aspect, which is the net debt to EBITDA ratio, or the debt to equity ratio. Louis Vuitton Moet Hennessy has really low debt, which is really great from an investor's or creditor's perspective, which makes the company less risky and volatile. And Kering has the problem of high debt to equity, as well as net debt to equity before interest. Then coming to an end, does ESG support the Louis Vuitton Moet Hennessy investment case? There are positive signals, like in the scope 1 and 2 emissions reduced by 37% versus the 2023 baseline. 70% of renewable and low carbon energy, really good. 91% of stores are fully lit by LED lights, and 4.3 million hectares are regenerated and preserved or restored in some, and 49% of recycled materials in glass, plastic, and customer packaging, which is also a great number. So it supports the long holding creditors perspective. So coming to a conclusion, financially, Louis Vuitton Moet Hennessy is more profitable. The operating margin is around 22% versus Kering around 11.1%. Also, the stronger earnings quality, higher net profit, and more stable operating performance. Cash flow is around 11.3 billion. Then the lower financial risk, net debt equity 9.9% versus 51.8%. Louis Vuitton Moet Hennessy is also better diversified, broad portfolio across 75 Masons and several business segments, and it's also overall a creditor-friendly balance sheet. The main limitations of Louis Vuitton Moet Hennessy are that luxury demand is cyclical, as well the growth slowed in 24 to 25 and now to 26 normally. and the ESG and supply chain risks remain also relevant after pushing EU standards. Now, thank you for your attention and wishing you a great summer holiday.